Look, I'm going to tell you something that most people on Wall Street don't want you to know, and I'm going to tell you right now because every single day that you don't understand this, you are bleeding money. They want you confused. They want you scrolling through Reddit threads at 2 in the morning, chasing hot tips from strangers on the internet, buying stocks because some influencer with a fancy car told you it was going to the moon. They want you to gamble because when you gamble, you lose. And when you lose, someone else wins. And that someone else is almost always a professional who woke up that morning, sat down with a cup of coffee, and read one document, just one document, that told them everything they needed to know about whether a company was worth owning. That document is the balance sheet, and today I am going to teach you how to read it in 10 minutes flat. Warren Buffett said accounting is the language of business. I'll take that further. Accounting is the language of money, and if you don't speak the language, you are not an investor. You are a tourist. You are walking through a foreign country where everyone around you is negotiating, making deals, building wealth, and you are standing there smiling and nodding because you don't understand a single word being said. That stops today, because here is the reality. Reading a balance sheet is not complicated. Wall Street wants you to think it is. They have spent decades building a mythology around financial analysis to keep regular people on the outside. But the truth is, once you understand the three core components, you will be able to sit down with any publicly traded company in the world, pull up their financials on Yahoo Finance or Morningstar, and within minutes know whether that business is a wealth machine or a debt trap waiting to collapse. And that skill, that single skill, is worth more than any stock tip you will ever receive in your lifetime. So let me break this down for you. A balance sheet is simply a snapshot. It is a photograph of a company's financial position at a specific moment in time. It answers one fundamental question: what does this company own and what does it owe? Everything else on the balance sheet is just an elaboration of those two ideas. And it all comes down to one equation, the most important equation in all of finance. Assets equal liabilities plus shareholders' equity. Write that down, burn it into your brain. Assets equal liabilities plus equity. That equation must always balance. It is not a suggestion. It is not a guideline. It is the iron law of accounting, and every single balance sheet ever produced by every company in the history of capitalism follows this rule without exception. Now let's talk about what those three words actually mean, because this is where most people either zone out or get fed a bunch of jargon that doesn't help them make a single better decision. Assets are everything a company uses to make money. Cash in the bank, inventory sitting in a warehouse, buildings, machinery, equipment, intellectual property, patents, brand value. If the company owns it and it has economic value, it is an asset. Think of assets as the tools in the toolbox. The more powerful the tools, the more work the company can do, and theoretically, the more money it can generate. But here is the critical thing I need you to understand. Not all assets are equal. Some assets are liquid, meaning you can turn them into cash quickly. Cash itself, short-term investments, accounts receivable, money that customers owe you but haven't paid yet, these are called current assets. They are the lifeblood of day-to-day operations. Then you have long-term assets, things like real estate or heavy machinery that you can't just sell tomorrow afternoon. When you are analyzing a company, you need to know the composition of those assets. A company sitting on a pile of cash is in a very different position than a company whose assets are mostly old equipment that is depreciating every single day. Liabilities are what the company owes. Debt to banks, bonds issued to investors, money owed to suppliers, called accounts payable, taxes owed to the government, future obligations like pension commitments. If the company has a legal obligation to pay someone something, that is a liability. And just like assets, liabilities are split into two categories. Current liabilities are debts due within the next 12 months. Long-term liabilities are obligations that extend beyond 1 year. This distinction matters enormously when you are assessing whether a company is in danger of running out of cash. A company can be profitable on paper and still go bankrupt if it cannot meet its short-term obligations. I have seen this happen. I have watched companies with impressive revenue numbers and great press coverage collapse because they could not cover what they owed in the next 90 days. The balance sheet would have told you every single time. Now we come to shareholders' equity, and this is the number that represents what actually belongs to you as an investor. Equity is simply assets minus liabilities. It is the residual interest. If you liquidated the company right now, sold everything it owned, and paid off every debt, what is left over belongs to the shareholders. That is equity. And within equity, the single most important line item is retained earnings. This is the cumulative profit that the company has kept and reinvested in the business over its entire lifetime, instead of paying it out as dividends. A growing retained earnings figure is one of the most powerful signals I look for when evaluating a business. It tells me that this company has been consistently profitable, and instead of blowing that profit, management has been disciplined enough to reinvest it and compound the business forward. Apple has hundreds of billions in accumulated earnings. Microsoft, Johnson & Johnson. These are not coincidences. These are companies that mastered the art of generating profit and reinvesting it intelligently. That is what a compounder looks like on a balance sheet, and that is exactly what you should be hunting for. But here is where it gets really interesting, because reading a balance sheet is not just about celebrating the good news. It is about spotting the danger before it blows up in your face. And there are two red flags I look for immediately every time I open a company's financials. The first is the current ratio. This is the single most important liquidity metric you need to understand. It is calculated by dividing current assets by current liabilities. Simple arithmetic. If that number is above 2, the company has a comfortable cushion. It has twice as many short-term resources as short-term obligations. If that number drops below 1, you have a serious problem. It means the company cannot cover its immediate debts with its immediate assets. That is a liquidity crisis developing in slow motion. That is a company that may need to borrow more money, dilute shareholders, or in the worst case, default on its obligations entirely. I don't care how exciting the product is. I don't care how visionary the CEO looks on stage. If the current ratio is below 1, I am not touching that stock until I understand exactly why and exactly how management plans to fix it. The second red flag is long-term debt relative to earnings. Specifically, I want to know if the total long-term debt on the balance sheet is more than 5 times the company's annual profit. Why 5 times? Because at that level, the company is essentially working for its creditors, not for its shareholders. Every dollar of profit generated is going towards servicing interest payments instead of building equity, funding innovation, or rewarding the people who actually own the business. Companies buried in debt at that ratio have almost no financial flexibility. When the economy turns, and the economy always turns, they have no room to maneuver. They cannot cut prices to compete. They cannot invest in new products. They cannot absorb a bad quarter without going back to the capital markets with their hat in hand, begging for more money at terms that will hurt existing shareholders. I have been in business long enough to see this cycle play out dozens of times, and it never ends well for the retail investor who bought the story without reading the math. Now let me show you how this works in the real world, because theory without application is completely useless to you. Let's take Apple. When you open Apple's balance sheet, the first thing you notice is the sheer scale of their current assets. They are sitting on tens of billions in cash and short-term investments. Their current ratio is healthy. They are not scrambling to cover next month's bills. They have the financial flexibility to weather downturns, buy back stock, fund research and development, and make acquisitions when the right opportunity presents itself. That is optionality. That is what financial strength actually buys you, the ability to make moves when others are frozen. Now look at their retained earnings. Apple has accumulated an extraordinary amount of profit over its history. That number tells you this is a company that has been printing money consistently and managing it responsibly. That is not luck. That is a business model that works, reflected clearly in the balance sheet for anyone willing to look. Now contrast that with a heavily indebted retailer, or a struggling airline, or a speculative tech company burning through cash. Open their balance sheet, and what do you see? Current liabilities that dwarf current assets. Long-term debt that is 10, 15, sometimes 20 times their annual earnings. Retained earnings that are negative, meaning the company has lost more money over its lifetime than it has ever made. And yet people buy these stocks. They buy them because of a headline, because of a tweet, because someone on television sounded excited about it. They never opened the balance sheet. They never asked the basic question. And when the company eventually struggles, which it will because the math always catches up, those investors are shocked. I am never shocked because I read the balance sheet first. Let me also talk about working capital because this concept is the difference between a company that survives a crisis and one that gets wiped out by it. Working capital is simply current assets minus current liabilities. It is the buffer. It is the financial cushion that allows a business to keep operating when things get difficult, when sales slow down, when a supplier demands early payment, when an unexpected cost hits the income statement. A company with strong, positive working capital has breathing room. It can absorb shocks. It can continue paying its employees, its suppliers, its rent, while it figures out how to solve the problem. A company with negative working capital is living on the edge every single day. One bad month, one unexpected disruption, and it is calling the bank asking for an emergency line of credit. I have been on both sides of that phone call. Trust me when I tell you, you do not want to be the equity holder in a company making that call. Here's something else I want you to think about. The balance sheet does not just tell you about the present, it tells you about management quality. The decisions that show up on a balance sheet today were made by management over the past years and decades. A clean balance sheet with manageable debt, strong liquidity, and growing retained earnings tells you that the people running this business are disciplined. They are not making acquisitions just to look big. They are not loading up on debt to fund flashy projects that don't generate returns. They are building something real, something durable, something that compounds in value over time. And conversely, a balance sheet loaded with goodwill from overpriced acquisitions, intangible assets of questionable value, and debt piled on top of debt tells you that management is playing games. They are engineering the appearance of growth without building genuine financial strength. That balance sheet is a warning. Treat it as one. I want to be absolutely clear about something before we wrap up. The balance sheet does not work in isolation. You need to read it alongside the income statement, which shows you how much money the company is making and spending, and the cash flow statement, which shows you how much actual cash is moving through the business. A company can report profits on the income statement while simultaneously burning cash, a situation that is always a red flag and would be invisible to you if you only looked at one document. Professional analysts look at all three financial statements together, triangulating the story each one tells against the others. But of all three, I argue, the balance sheet is the foundation. Start here. Build your understanding here, because if the balance sheet is broken, nothing else matters. The bottom line is this. Every stock you have ever bought, every stock you are considering buying right now, has a balance sheet. It is public information. It is freely available. It is sitting on Yahoo Finance or Morningstar or the company's own investor relations page waiting for you to open it. The question is whether you are going to be the investor who looks or the gambler who doesn't. I have made my career by looking. I have built businesses, invested in companies, and made decisions worth hundreds of millions of dollars, and every single time, the balance sheet was part of the conversation. Not because I enjoy paperwork, but because the balance sheet is where the truth lives. Not in the press release, not in the earnings call, not in the analyst upgrade, in the balance sheet. So here is your homework. Pick any company you own stock in right now, or any company you are thinking about buying. Go to Yahoo Finance, click on Financials, open the balance sheet, find the current ratio, find the long-term debt. Look at the retained earnings trend over the last 5 years. Ask yourself, is this a company that is building wealth, or is it a company that is borrowing time? Once you can answer that question with confidence, you will have crossed the line from gambler to analyst, and that crossing changes everything. Stop being a tourist in the market. Learn the language, read the balance sheet, because the investors who win are not the ones with the best tips. They are the ones who did the work that everyone else was too lazy to do.